So you have some extra money and you want to invest, but you're new to it and it can seem really confusing and overwhelming. In this video, I want to break it all down into small, manageable chunks for all the beginners out there that have been put off. So this video is a beginner's guide on how to invest for beginners in 2025, or anytime really. The video can be broken down into 6 parts. First, what is investing anyway? Second, what should you invest in? Third, why should you invest and not save? Fourth, how much should you invest? Fifth, I'll actually do a live walkthrough as I actually buy some shares. And sixth, we'll take a look at 3 popular investing strategies to get you started today that are used by beginners and pros all over the world. If you're a beginner, you'll finish this video with a solid plan to get started investing today. This video is sponsored by Investing Pro, an incredible tool I use almost daily to find investment ideas, analyze stocks, and validate my investing strategy using a feature similar to ChatGPT, but specifically built for investing. We'll talk more about them later and reveal a special discount to grab this awesome tool at 50% off, plus an extra 15% off using my discount code BRENT. But for now, what actually is investing? Basically, investing is when you put your money into something with the goal of growing it over time. When you have cash, you have 3 options. First, we can spend it. Then the money is gone. Second, we can save it. We might earn a little bit of interest, but largely it sits still. And third, we can invest it by purchasing assets. These assets can grow in 2 ways, either by increasing in value or paying an income, both requiring little work from us. This is why it's often said that investing is putting money to work, because you're not doing anything, your money is. Assets come in many forms. It could be part ownership in a company like Apple, which is what we call shares or stocks. We can also own a basket of shares called a fund, which can be subdivided into ETFs, index funds, mutual funds, but they're all baskets of shares. Once you buy the basket, you get a little bit of everything. Outside of shares, other assets could include property, Pokemon cards, Birkin bags, metals like gold and silver, artwork, collectible cars. There's a huge range of options. But the asset must provide an income or hold value that increases over time due to value or rarity. So when we invest, we are basically doing the opposite of spending. When we spend, our money is gone instantly. When we invest, we intend for our money to grow over time. So now that you're on board with this whole investing thing, the next big question is, what should you invest in? So let's take a look at the risk-reward chart. On the x-axis, we have risk, and on the y, we have returns. On the left-hand side, we have cash and fixed interest. This would include term deposits and savings accounts, but they tend to have lower returns. In the middle, we have property. It's extremely rare to have wild price swings in property, as its value tends to move more gradually over years, not months. Then we have shares. The value of shares can absolutely go to 0, but it can also grow by 100 times, and if you choose correctly. And finally, we have alternative investments like crypto, private equity, venture capital, all the really spicy stuff. Smart investors buy a piece of several different asset classes to diversify their portfolio and reduce risk. So if one of their investments goes down, another is there to go up, working together to avoid portfolio loss. This is what we call diversification, and it's especially important when investing in individual stocks. Many beginners make the mistake of chasing stocks that are popular in the moment. Maybe a colleague had a stock tip. The news said another was at an all-time high and predicted to go higher, or maybe it has grown over 500% in the past couple years. This is just a terrible idea. Just because something did well in the past doesn't mean it's guaranteed to continue doing well. We saw this with the likes of Kodak and BlackBerry, once top in their field with soaring stock prices, but at some point came crashing down, never to recover. So ensuring that you have the right mix of investments and tools needed to analyze and research your options is critical to protecting your invested capital. A tool that I use daily to save time and make this process easier is investing.com, who are also today's video sponsor. When you subscribe as a member, you get access to ProPicks. ProPicks uses artificial intelligence to analyze the market and gives you exciting new stocks every month. It saves me spending hours researching stocks, and I can just jump into the tool and make informed decisions in minutes. Once I find a couple options, I jump into Warren AI that sits alongside ProPicks. It's basically ChatGPT for investing, and I can ask it to research stocks or industries that I'm interested in. It gives me a solid summary of things to look out for, potentially highlighting things I would have otherwise missed. As an investing.com member, alongside ProPicks and Warren AI, you get access to a whole suite of other powerful features. With the stock screener, you can filter thousands of global stock and ETF options, while Ideas allows you to look into and copy the strategies of legends like Warren Buffett. Investing.com is currently running their flash sale, offering up to 50% off on Investing Pro and Investing Pro Plus for a limited time. But here's the exciting part. I've managed to get you an exclusive extra 15% off on top of that. That means you can grab Investing Pro at the lowest price of the year, a total discount of up to 65%. Just click on the link in the description to claim your subscription and start using Investing Pro today. This special offer is only available for a limited time, so don't miss out. But why should we invest over just keeping our money at the bank in a savings account? Let's say you've got $1,000 in the bank. In a year's time, it's still $1,000, and in 2 years, 3 years, 4 years, it's still $1,000. So it's safe, it's secure, and you haven't lost anything, right? You've still got your $1,000. But over time, that money is actually losing value thanks to inflation. Inflation is where the price of stuff goes up and the amount you can buy goes down. The $4 mince and cheese pie becomes $5, then $6, then $7, and so on. So while we still have our $1,000, it has lost value and buys less. So saving alone isn't enough to fight the tide, and we all know banks are greedy. So even if you earn interest, it still isn't enough to cover inflation, and it hasn't for years. And that is where investing comes in. When you invest your money, you're putting your money to work. Using a tool like Investing Pro, we can filter through thousands of potential investment options to put our money to work. When you buy a stock like Tesla or Amazon, you're actually buying a small piece of the company. When a company faces inflation, they usually increase their prices. When they increase their prices or expand their business, they make more money. When they make more money, the stock becomes more valuable. When the stock becomes more valuable, that's when the stock price goes up. When the stock price goes up, your investment has appreciated in value. That's fundamentally what we're talking about here. Investing your money through buying a piece of a company, not putting it to sleep at a bank. The real game changer, however, is the eighth wonder of the world, compound interest. It's basically a snowball effect where over time you earn returns, and then the returns start making their own returns and your money starts to grow exponentially. It's a lot easier to explain using an example, so let's take our $1,000 from earlier. If we invest $1,000 every month and earn an average return of 8% per year, it would take 77 months or just over 6 years to reach $100,000. Out of that $100,000, 77 came from the money we personally put in, or 77 lots of 1,000. The remaining $23,000 came from the investment returns, increasing every month. That's the money, our money, earned for us, which is why we say investing is putting money to work. After we've saved $100,000, things start to accelerate with the effect of compounding. Our next $100,000 comes after 50 months, the next after 38 months, then 30 months, and it keeps getting faster and faster. At 306 months, we'd have $1 million in our portfolio. Of that $100,000 in our portfolio, just $306,000 of it came from us putting money in. The remaining 70%, or $700,000, came solely from investment returns, and that is the magic of compounding. This is why investing is so critical to building long-term wealth. You don't have to be a Wall Street guru to time the market. Time in the market matters more, allowing your money to multiply. So if you're wondering when is the best time to start investing, truthfully, it's as early as you possibly can. The more time you have available for your money to compound, the better. Even if you don't have a lot to invest, you can still take steps today to not only benefit from time, but also in creating good money habits. The next natural question becomes, how much should you invest as a beginner? You don't need hundreds or even thousands to start. All you need is $1. There is no such thing as a minimum to get started, but how much you make in the stock market is going to be limited by the amount that you put in. For example, if you invest $10 and it goes up by 10%, you've made $1. But if you invested $10,000 and it rose by the same percentage, you'd have made $1,000, as that's 10% of 10 grand. A good rule of thumb is that you should only invest an amount of money that you don't need for several years. So if you're saving for a holiday or a house deposit and you'll need the money in the next couple years, this might not be a good idea. It's impossible for us to know if the stock market will go up or down in such a short period of time. If it goes down in the short term, you might not have enough time to wait for it to recover. Anyone that tells you they're certain the stock market is going to go up either has a crystal ball, which is probably not true, or should be taken about as seriously as a punter at the races. The reality is investing's a long-term commitment, and there's good years and there's bad ones for every single asset class. It's impossible to say with certainty what is coming next. If I knew that information, I'd be doing it myself. This chart, for example, shows us how each asset class has performed since 2016. European stocks top the tables this year, but next year, maybe they drop 5%. It's literally impossible to predict, so diversification is important and investing over several years to avoid short-term shocks. Another topic that doesn't get enough airtime for beginners is when to invest. Not when to start altogether, but when to actually purchase an investment. You'll often hear the saying, buy low, sell high. But this is easy in theory and hard in practice. When you buy a stock, someone needs to sell a stock. The buyer thinks it's priced lower than what it's worth and likely to go higher. And that is why they're buying. Whereas a seller thinks it's overpriced, and that's why they're selling to avoid a future loss. Who's right and who's wrong is something you'll only know retrospectively. This dynamic plays out for every stock daily. It happened when Meta was priced under $100 a couple years ago, and happens today at over $700 a share. Unless you've got luck on your side, it's impossible to know whether it's a good time to buy or good time to sell. So what many people do is called dollar cost averaging. It sounds complex, but it's actually really simple. You invest a fixed amount of money on a regular schedule, no matter what the stock market is doing. For example, you might invest $1,000 into an S&P 500 index fund every month, whether the price is high, low, or somewhere in between. So it doesn't matter what the stock market's doing, I always put in my $1,000. This strategy helps reduce the risk of buying at a bad time. When prices are low, your fixed amount buys more shares. When prices are high, it buys fewer. Over time, this averages out the cost per share, smoothing the highs and the lows. For example, Google stock has moved between $140 and $200+ a share over the past year. If you invested a little bit each week, you'd buy a mix of cheap and expensive shares. Your average price would be lower than if you had gone all in at the peak in January. The other good thing with dollar cost averaging is it discourages you from panic selling. One of the biggest mistakes beginners make is selling when the market drops. When Trump announced tariffs, the market plummeted and Google stock, for example, dropped to $142. If you had bought a month prior at $170 a share, you'd have lost 16% of your money. If you held it to today, you'd be up by about the same. The reality is you only really lose money when you sell. If you hold on, the price can rebound or even surpass where it was before. That's why investing over the long term is important, and dollar cost averaging allows you to set and forget, and not get swayed by short-term fluctuations. Several brokers allow you to create an auto-invest order, where the broker sets a dollar amount and frequency to invest on your behalf. This is a way of putting your investing on autopilot and doing the dollar cost averaging strategy. This is similar to investing in KiwiSaver or other retirement accounts, where every payday, some of it goes towards dollar cost averaging into a fund of mainly stocks. Let me show you a live example, step by step, how to purchase a stock. Next to me, you can see a live recording of what I see on my phone. The first place to start is what stock should we look at? My preferred tool is Warren AI, which is a part of the investing.com subscription. Rather than me doing all of the research, I'd rather they do it for me. So as you can see, we have the home screen just here. And pretty much it's like using ChatGPT. You just put in your prompt and it goes away and finds the information. But they're really good at investing research. So a good prompt for us to start is probably by looking at the largest companies on the ASX. So Warren AI has gone away and it's found the information for me. As I scroll down, we can see some of the names that come up, like Commonwealth Bank, there's BHP. Are there any others? We have Westpac in there as well. So let's say a name that's interesting to me is Westpac, so I can ask more information from Warren AI. It then goes away and finds information for us that would be interesting from an investing point of view. So as you can see, they've given us a little bit of information here about their stock price, some of its recent price movements. We've got stuff about its net profit, net interest margin, how that's doing. And as we scroll through, they also list out some of the strengths and weaknesses about the stock, what's positive and what's negative. So that gives us a great place to start, and let's say I wanted to buy this stock. So now what I need to do is jump into my broker. What I'm using today is Sharesies, which is used by over 700,000 users in New Zealand and Australia. Now it doesn't really matter what broker you use, it really only matters from a fee perspective, maybe how the shares are held. Like in Australia, maybe they're chair sponsored, and the UI can be quite different between the brokers as well. So to find Westpac stock, we can simply jump into Buy Investments and look them up. So I simply type Westpac and it should come up. For simplicity, let's just pick the New Zealand one. And as you can see, we get a lot of information about Westpac. We can see a bit of information about the company, its current price, what exchange it's currently listed on, which is the NZX, which is here in New Zealand. And as we scroll down, we get a bit more information about the company. We also get a price chart and some information around its pricing and its dividend, which is pretty high at 4.24%. If we click into that, we can see the history. So as we spoke about earlier, there are two different types of returns you can get in the stock market: capital gains, which relates to the price going up, and income, which is something like dividends for a stock. So those are two ways that we can make money in the stock market, and it depends on your preference which one you prefer. So if we click out of that, let's say we want to purchase some shares. We can simply click the buy button at the bottom. That gives us two options: market buy and limit buy. Market buy is if we want to put $5 in and we don't care what the price is that we purchase at. This is the fastest, as it basically executes at the next available price. A limit buy, on the other hand, is where we say I don't want to purchase the stock at any more than a certain price. So currently Westpac is 41 New Zealand dollars. If we set a limit at $40 for example, we'll have to wait until the price comes to that level. At that point, someone's willing to sell to us at $40 a share. So when that time comes, the order will execute. If the price never comes to $40 and no one wants to sell to us at that price, then the order will never execute. So that is the risk when we do a limit buy. So for simplicity, let's do a market buy. What we do here is we simply put in the amount that we wish to invest. So let's say $5 just to keep it simple. With Sharesies and many other investing platforms, just because it's $42 a share doesn't mean we need $42. It's something called fractional share ownership, where they divide it into many different little parts. So of my $5, $4.91 is going towards buying shares. Sharesies takes 9 cents as their transaction fee. So if I'm happy with all the information on this page, I can simply press buy. And voila, our order is going through. Now we can't buy shares at any old time. We need to wait for the market to open. So we can click at the top right of the screen to see when the exchange is open. Here in New Zealand, it's from 10 AM to 5 PM. And if we're investing in Australia, I think it's around midday through to about 6 PM. So if you put your orders through during those hours, it will transact pretty quick. But outside of those hours, you need to wait for the market to open for the exchange to take place. So that is how easy it is to purchase a stock. Now you've got the basics down. Let's talk about your next steps and investment strategy. These will help you formulate a path forward and craft your investment philosophy. First up, there's the core satellite strategy. This is one of the most popular strategies for both beginners and experienced investors. I, for example, follow this strategy. The idea is simple. You have a core portfolio made up of stable, diversified investments like index funds and strong, stable blue chip stocks. This acts as your foundation. It's highly diversified, global, stable, and grows with the broader economy. Around that core, you add satellites. These are smaller positions in specific sectors, themes, or individual stocks that you believe in. Your satellites are where you can really play with spicier investments, like perhaps a bit of Rocket Lab or a bit of crypto. A common approach for investors is to put 80% of their money into the core and 20% into the satellites. This strategy keeps your portfolio diversified and resilient, while still giving you the freedom to invest in more speculative assets with added risk. Alongside the core satellite strategy, you have the set and forget strategy. This one is perfect for those that want to keep things ultra simple. You simply choose a handful or even just one diversified index fund, automate your contributions each month, and leave it alone to grow. This is the definition of dollar cost averaging. While some people like to find and analyze individual stocks, here we adjust dollar cost averaging into a little piece of everything. There's no tinkering, there's no guesswork, just consistent investing over the years. It's ideal if you want to remove emotion from the equation and focus on time in the market, not timing in the market. For beginners wanting to dip their toes into the world of investing, this is perfect to just see how it works without spending hours researching stocks. Over time, you might want to dabble in individual stocks, and that is completely fine. Starting here and over time shifting to a more core satellite approach is a measured way to get immersed in the world of investing. And finally, there's the strategy of value investing. This one requires a bit more effort, but it's minted some of the world's richest people, including legendary investor Warren Buffett. Essentially, value investing is about buying quality stocks at a discounted price and holding them until their price returns to their true value. When researching a stock, we might think a fair value is $100, for example, but is currently trading at $120. In this case, we wouldn't invest, even though it's a really good company, but it's too expensive for our strategy. In 6 months' time, the stock starts to trade at just $90 a share. We still believe it's fairly valued at $100, and we can buy it now for a 10% discount. Value investing would be buying the stock at $90 and holding it until it once again returns to $100. At that point, we could sell it or continue to hold it if we believe the business is growing and its fair value will continue to rise over time. Back in the 1960s, Warren Buffett had his eye on American Express stock. At the time, there had been a financial scandal and the stock was trading well below its true value. Warren waited while investors panic sold their way out of the company, despite the underlying brand and business model remaining strong. He started buying American Express stock once he believed the price was so low relative to its value, it would be crazy not to buy. So he bought the stock in 1964 and today owns over 20% of the company. For every dollar that he put in 1964, it's worth roughly $100 today. This shows the power of A, investing over the long term, and B, the value investing strategy. Many investors turn to price to earnings, price to book, debt to equity, and other ratios to find value stocks. Investing Pro makes this process a lot faster with Screener, allowing you to filter for these value factors specifically. It's no surprise to see Warren Buffett's Berkshire Hathaway itself at the top of the list, among several other well-known companies with the attributes of value stocks. If you made it this far, I wish you all the best with your investing. If you have any other questions at all on getting started, drop them down below and I'll be answering every single one. Also make sure to check out Investing Pro and get this amazing tool for 50% off, plus an extra 15% discount using my code BRENT. It's incredible for finding stocks, analyzing companies, and spending a lot less time scanning for investment options. Make sure to subscribe and check these videos out next, where I'll be sharing more tips to get started investing today. Thanks for watching, and I look forward to catching you on the next one. Cheers.